Hey guys, so today I want to talk to you about closing gaps. At the moment, we're seeing a nice rally develop. It's a Christmas rally developing. We've actually been buying the market this week over the last 2 days, getting involved with this big move up. But I don't want to talk to you about the Christmas rally today. I want to talk to you about trading the closing gap. The closing gap is marked against the previous day's close. So every day the FTSE opens at 8 o'clock in the morning and it closes at 4:30 p.m. UK time. The level at which it closes is what we want to focus on. So yesterday we can see that the FTSE closed at 7,500. We can see, here we go, close 7,500. This is a daily chart. And if we open up the next day above the previous day's close, we call that an up gap. And if we open below the previous day's close, we call it a down gap. And what we're doing is we're expecting, well, if the market moves back down to fill the gap at 7,500, we call that closing the gap. So the pattern we want for this is actually 3 up days in a row. So you can see at the moment we've had 3 up days in a row. So today if we open above 7,500, it will be a high probability sell back down to 7,500. The stop will be 30% ATR. So ATR stands for average true range, and it's 30% of the 5-day average true range. So whatever the FTSE's moved on average over the last 5 days, 30% of that is our stop. Now, the same applies to the downside as well. If we've had 3 down days in a row, and we gap below, so we open below the previous day's low, we would buy for a retracement back to the previous day's close as well. Now in terms of risk reward, sometimes the opening price and your stop won't be in line, in which case it might make sense to wait for a spike up. So today, just for example, just say 30% ATR is 20 points. So we're looking to sell the open or just before the open. We've got a 20-point stop. And just say the market opened at 75.07. Well, the risk reward isn't in balance there. So in that case, in that instance, I would probably wait for a spike up. Actually, we did something similar in the live room yesterday. We couldn't get the right risk reward. So instead, we waited patiently for the market to spike up. Now, if it doesn't spike up when it moves to target, well, then that's just a mistrade. That's the way it goes sometimes. But it's important to try and get 1-to-1 on your trades, or near enough. It doesn't have to be bang on 1-to-1, but if you're risking 1 and you're making 1 and you've got at least a 70% hit rate, then you've got a license to print money. So that's really what you are after. So the market hasn't opened yet. It will open in a few hours, and certainly if we are opening above 7,500, I'll be looking to sell back down to that level with a stop of 30% ATR of the 5-day average true range marked against the ATM price, whatever that is. And I would expect that to be hit pretty quickly because we've had 3 up days in a row, so it's a nice market inefficiency. When we get that pattern and we get an up gap, or we get 3 down days in a row and we get a down gap, the market's out of balance. And remember, the big traders don't want to buy or sell the highest or lowest prices, so they're looking for pullbacks in the market, and that's why this works so well.